the central banking community has been taking on gold the last couple of years at a very rapid rate. And now, if maybe they want to mitigate a further, let's say, blip in the system, still believing they're all powerful, which they're not, they might take a futures position that will take, gold at a $2,000 level and see it go to 2,200. I mean, I just checked the charts. I was on a little TV show, to say little, it was on a Mideast television program this morning, giving a gold update for them. And, 22 trading days, gold went from $2,024 to $2,224. A $200 increase in 22 trading days, even on the gold market, is fairly large, is substantial. And this shows you nervousness in the market and who's doing it.
DavidMorgan holds prominence as the publisher of the Morgan Report and recognized for his expertise in precious metals analysis. In this video, DavidMorgan delves into the central bank's vigorous pursuit of gold in recent years. He interprets the recent increase in gold price over 22 days as a sign of market nervousness, with savvy investors strategically buying gold in anticipation of further increases. China's central bank added 160,000 troy ounces of gold to its reserves in March, it said, in line with the market view that persistent official sector demand had supported gold's recent rally. Spot gold jumped 9.3% in March, its strongest monthly performance since July 2020, despite a strong dollar and elevated U.S. real interest rates. That rally has continued, with gold hitting successive record highs during the last 7 sessions to touch $2,353.79 per ounce on Monday. At the forefront of gold price dynamics, Morgan points out the gold supply's stability compared to the 9-fold increase in the monetary base since around 2023. Gold prices generally track the trajectory of the money supply, rising alongside increases in M2. Gold prices in recent years have certainly climbed to new heights. However, the actual ratio of the price of gold to M2 has fallen quite low. In addition, the low velocity indicates that the American economy isn't terribly healthy at its core. At some point, people are going to start searching for better stores of value than their paper money. In his analysis, Morgan stresses looking beyond gold's paper price, highlighting its long-term value despite short-term fluctuations. He humorously referred gold's past highs, but urged focus on its purchasing power over time, not just its nominal price. The upward trajectory of gold prices over time mirrors the erosion of purchasing power of the U.S. dollar. When gold peaked in 1980, its price correlated to a 97% loss of purchasing power in the dollar up to that point. The move was spectacular in nature, but it was mostly catch-up to the decline in the dollar that had been accruing for the previous 4 decades. Now, we present the clips of DavidMorgan's insights from his recent interview with ITM Trading. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Some of it is from Chinese buying, but it's primarily algorithms and paper trading. That's the crux of it. And why is that? That's a deeper question I really can't answer. I suspect that the bankers at large know what's coming. Their really only defense is to do what I said earlier on the broad brush view. What happens during a collapse, fiat fails, you go to gold. Fiat fails, you go to gold. And so the central banking community has been taking on gold the last couple of years at a very rapid rate. And now, if maybe they want to mitigate a further, let's say, blip in the system, still believing they're all powerful, which they're not, they might take a futures position that will take, gold at a $2,000 level and see it go to 2,200. I mean, I just checked the charts. I was on a little TV show, to say little, it was on a Mideast television program this morning, giving a gold update for them. And 22 trading days, gold went from $2,024 to $2,224. A $200 increase in 22 trading days, even on the gold market, is fairly large. And this shows you nervousness in the market and who's doing it. I'm guessing it's probably the smart money that wants to buy that cheap $2,000 gold. I want to go a step further. When I wrote one of my first pieces on the internet called Engineering the Price of Gold, people always want to know, well, what is the price of gold? When do I sell it? And they sell it when you sell it. But the theory is, how much gold is there versus how much paper is there? I use M0, what's called the true money supply. If you do the math, dollars and gold, it's how many dollars per ounce of gold. It came out $2,500 an ounce in 2002. And we're only at 2,200 now. If you do that same exact math, the supply of gold in the treasury has not changed. That's a constant. And gold is constant. They're both constants. But what has changed is the M0, the base money supply. You know what the number is now? It's 9 times higher. It's almost $20,000. So it's a moving target. Gold doesn't change. The depreciation of the dollar does. And it's been a ninefold change since 22 years ago. Well, what I just said, I mean, it's a moving target, so it's hard to aim correctly because you see this, it's a new high, but 2,200 adjusted for today's inflation would have to be much, much higher to be equivalent to 850 on my birthday when I was 27. Gold hit its all-time high in 1980. But the point is, you don't want to focus too much on the paper price, and we all do. Even I do at times. But you want to look at value. What does gold buy in terms of another commodity? What does it buy in terms of a house? What does it buy in terms of men's or women's clothing? You want to see if it's undervalued, not based on price, but based on what it does in the sector on a long-term basis. So, the old adage, an ounce of gold is a men's suit and shoes and a hat and an umbrella and a belt and all that stuff. So if you could buy a men's warehouse, you could buy a clothing store for an ounce of gold, then it's overvalued. That's the kind of thinking you got to kind of train yourself to do to get the idea. But the main idea is buy the right amount, put it away, and forget about it.
During the interview, DavidMorgan addressed the global financial situation, emphasizing the widespread debt in U.S. dollars. He proposes that the envisioned Great Reset aims to tackle this debt burden by restructuring the financial system, easing the burden of debt accumulation. Gulf Cooperation Council, GCC. Banks' U.S. dollar debt issuance is on track for its strongest quarter ever in 2024, with issuance already exceeding the full year 2023 total, Fitch Ratings says. Annual issuance in 2024 and 2025 could exceed the 2020 record of $25.2 billion, boosting liquidity to meet strong credit demand. Regarding the current economic system, Morgan raises concerns about the effectiveness of traditional methods, such as adjusting interest rates. He suggests exploring alternative strategies like asset repricing or debt restructuring as potential solutions. Let's get back to the interview.
So where we are right now is a precarious place because it's not a one nation state. It's not the Weimar Republic. It's not Argentina. It's not Turkey. It's not Argentina. It is global. Now the BRICS have mitigated the problem somewhat by trading with each other's currencies and really circumventing the dollar. But all those dollar debts to all these third world countries and other nation states, first world countries, still exist and must be paid back in dollars. So I see it as what the Davos folks and others talk about, the Great Reset. What they're really talking about is resetting the financial system or the monetary system to a new paradigm where they can actually wipe out or mitigate a lot of this debt that's owed between themselves and between investors and investment banks and on it goes, and start over. So again, the physical economy really wouldn't change that much other than who owns it. I mean, they can do whatever they want with the interest rates, and this time it won't work. I mean, last time when Volcker came in, there was so much room in the economy to swallow those kind of heavy yields that were required to pay back the loans that people were giving for buying US dollars in the future. It worked, but it won't this time because we are upside down, let alone the long term, the 10-year note or the 30-year bond. So they have to be discounted or they have to be repriced. And I think there'll be a repricing of some type. Could be that we negate all foreign holders. I mean, we already did it to the Russians. It's, oh, David, you're using your imagination. That will never happen. Look, folks, it's already happened. We basically took what was it, 300 billion that the Russians had and said, persona non grata, your dollars aren't good for transactions anymore. This is very, very serious stuff. And people say, well, you're wrong. Well, how wrong am I? Because you look at the retail decimation from 2020 till present day in the United States, and see how many retail stores are gone. Some of these have been around more than 100 years. Type in corporate restaurants decline in revenues and find out how many of these Applebee's and other type of restaurants have closed multiple stores because they're losing money. I mean, the depression doesn't start with an overnight deal. I mean, the 1929s they attributed to the stock market crash. which is a good marker, but it really wasn't that day. A lot of things led into that and after that. And it's the same situation here. We're slowly contracting the economy. The soup lines are getting longer and longer, but you don't see them this time because in the States we get an EBT card, which is fine with me. I'm not against helping others at all. In fact, I'm a pretty giving guy. But the point is, you don't see it because they've got a little plastic card just like I have when I go through the grocery store. You just don't know that the state is supplying that money to them. But the state runs out of
That's a
money
very good point.
eventually. And when the state runs out of money, then you have further problems.
As central banks continue to bolster their gold reserves and investors flock to precious metals, the stage is set for a potential reevaluation of the current monetary system. Experts recommend hedging against inflation by investing in gold, which has maintained its purchasing power over decades. What implications might this surge in gold demand have on the future of global currencies and economic stability? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.